if this continues to play out in the way that we think and the trend continues, there is no reason global GDP can't double in a year and even double in a week. And this is what I think gets us out of the debt trap. This is the whole idea of this exponential age thesis that I've got, is this nexus of technologies all hitting exponential adoption phase at the same time and kind of interwoven with each other, drive a productivity miracle, far and away larger than the one observed in the 1950s and 60s, which also got us out of the debt trap then, the post-war debt trap. Very similar situation. And it took us a while, a bit of yield curve control plus new technology. This time around, we might get yield curve control, but the new technology is really going to change everything.
Raoul Pal is a renowned macro analyst, commentator, and a well-known face in the digital asset space. Pal is somewhat of a contrarian regarding the current macro environment, with some interesting and unique views that differ from the general gloomy and bleak atmosphere that has settled over the global economy in the past few years. Over the past few years, sound money advocates have constantly warned about the rapid debasement of fiat currencies and how it will lead to a widespread collapse that will destroy the entire global financial system. According to many of these sound money advocates, we are quickly approaching a time when even strong fiat currencies like the dollar will be worth much less than the paper on which they are printed. However, Powell, a former Goldman Sachs executive, chooses to be a dissenting voice amidst all the gloom and doom calls. Powell believes there is still a way out for the global economy and financial system, a simple solution that directly addresses two major parts of the problem: productivity and demographics, the development of which has remained almost completely flat in the developed world for at least a decade. As a result, it has become impossible to broaden the world's productivity and consumption rate enough for us to take on more debt. Yet, taking on more debt is the only way forward for the global economy. For example, the United States debt to GDP ratio is almost 130%, with almost $2 trillion in budget deficit. This means the Treasury Department has to issue way more debt than originally planned to even things out, not just in 2023, but well into the foreseeable future. This is why many sound money advocates warn that this fiscal path is completely unsustainable. But Powell believes there is a way forward for the United States and the entire global economy. He recently appeared for a purely macro discussion on Steno research, during which he described his outlook on the world's macro situation as we approach what many believe will be a pivotal moment for us all. We will now bring you clips from Raoul Pal's latest interview as the renowned macro guru gives a unique and fresh perspective on the long-term macro picture. Please watch, share, and like this video. Also, ensure you subscribe to the channel, turn on post notifications, and drop your comments and observations on Pal's video in the comments section below. Thanks, and enjoy the video.
I think people are confusing current economic conditions with the recession that they desperately want versus the markets discounting it, the forward-looking stuff like crypto and tech discounting it in 2022. They all had raging bear markets. Right now, we've got the Russell 2000, oil, copper, all of these things in present-day slow economic conditions. Do we get a full recession or not? Doesn't really matter. It was priced in the stuff that I care about. But the forward-looking stuff, all of the forward-looking indicators from ISM are all pointing firmly higher. So we're around the trough of the cycle. Doesn't mean inflation picks up from here. In fact, because inflation's so lagging because of owner equivalent rents and wages, that it should continue to deflate all of 2024, particularly at the core level. And the headline level, we think, continues to fall. So, we're still of the camp that headline inflation probably gets to zero next year and core inflation too, which I don't think anybody's prepared for because everybody's on the sticky inflation camp. Now, let's worry about inflation in the next business cycle when it heats up, not at the beginning of the business cycle. That's the macro summer, spring to summer transition is generally falling inflation, rising growth. And that's what we're seeing. All the forward-looking stuff is clearly macro spring into macro summer.
This is not a late cycle dynamic, is it?
No, this is early cycle. It's exactly as it should be. So we've had the ISM troughing, all the forward-looking indicators pointing up. The business cycle dominoes mean that the things that the Fed look at, inflation and unemployment, are the last shoes to drop. which is why they've been very slow on this cycle. So what they will see is unemployment rising somewhat. Nobody expects a massive rise in unemployment, but a bit stickier. And I think AI and stuff like that will make it stickier. I don't think most of the jobs lost in Silicon Valley are coming back. So people have to reorganize themselves and to find different work and stuff like that. And then inflation, I think, continues lower for at least next year, and then it'll start picking up again, as all business cycles do. And I don't know where the story that it's the 1970s all over again comes from, because I don't see it anywhere in the data. Of course, inflation will pick up next time. Of course, the year-on-year effects will make it look stronger. So we will get a rebound in inflation. But the reality is if you think that wage earners have the power versus a world of AI and robotics, I mean, that's a different world. This is not the 1970s of your parents.
There are many important examples that support Raoul Pal's theory that increased productivity and economic expansion will help take on the debt burden so we can continue to kick the can down the road with periodic money printing. One common example that macro analysts like Powell and Lynn Alden have shared is how globalization efforts helped in the early 1980s when the country's massive debt first became a widely debated issue. The national debt of the United States hit $1 trillion for the first time on October 22, 1981. It became a very hot political issue because, unlike today, Americans still appreciated how huge that figure is. Then came the globalization efforts, primarily reflected by technological advances that made it easier and quicker to complete international transactions. According to the International Monetary Fund, the 1980s and the 90s were the decades of globalization. In fact, the term globalization began to be used more commonly in the 1980s. It was also around this that China adopted its open door policy, a new policy that opened the door to foreign businesses that wanted to set up in China. All of these developments helped the US kick the can down the road for another 40 years. If the artificial intelligence revolution is as grand as Powell predicts it will be, we could get another 40 or 50 years of further developments and possibly avoid the gloom and doom many people have been predicting. Let's get back to Powell's interview.
And every business I speak to is now starting to utilize AI. And that means that they will hire less. Doesn't mean they lay off people necessarily, but they'll hire less in the business cycle, which is fine because unemployment's pretty low right now anyway. And we've seen that kind of behavior in Japan. Unemployment stays low regardless of the cycle because the labor force shrinks. And the labor force shrinks in the US for the same reasons, demographics. But really how you need to frame AI is, okay, GDP growth or trend rate of GDP is driven by population growth plus productivity growth plus debt growth. Now, debt growth stopped in 2008. All debt growth now is really servicing of old debts. It's the ongoing repayments of debt cycle. Productivity growth and population growth in all the developed world has been falling, which is why trend rate of GDP has been falling. So trend rate of GDP has gone from the early 90s of 3% down to 1.75 now. So it's been falling because of demographics. But now you introduce workers or new productive units into the labor force, which is AI and robots at infinite scale. If I look forwards, I only see an increase in AI and an increase in robots. We're seeing that in every factory around the world of the robots. And when robots have AI, they become even more productive. So this now mimics humans because you're infinite scaling of knowledge and applied knowledge. So therefore, it kind of solves the population problem. This is one of the reasons why China is talking so strongly about robotics as a core part of their future, particularly humanoid robots, is because they don't have the population growth. But this is a big answer. And when you do that, you start increasing productivity because productivity was dragged lower from demographics. The other part of productivity is the lowering of energy costs. Basically, electricity prices across the world have underperformed inflation. They've been relatively steady, except last year, obviously. So it's been steady. I looked at UK inflation prices for the last 50 years, electricity prices for the last 50 years earlier this morning, and they've been flat for a long time. But as we introduce more renewables, as we introduce cheaper renewables, there is a exponential downwards in cost in this stuff. It's just you can't do enough of it and you can't store enough of it. But as technology improves, the overall cost of electricity will come down. And so therefore, productivity is really the output per kilojoule of energy at a core first principles basis. So if your unit of energy cost goes down by half, it doubles your productivity. And then you add the AI, the robots, and AR, VR, genetic sciences, all of these things on top, and you get a miracle, an economic miracle. Now, that's not going to happen this cycle, but we'll start to see the seeds of it. But really after the next cycle, by the time we get to 2030, it becomes almost impossible to predict what economies look like. There's a group at Oxford University where Nick Bostrom, who's one of the thought leaders on all of AI, and where a lot of the work came from, there's an economist involved in that group that says, listen, if this continues to play out in the way that we think and the trend continues, there is no reason global GDP can't double in a year and even double in a week. And I get it. It's directionally right.
Yeah.
But it won't be now. But that's what's coming. This is what I think gets us out of the debt trap. This is the whole idea of this exponential age thesis that I've got, is this nexus of technologies all hitting exponential adoption phase at the same time and kind of interwoven with each other, drive a productivity miracle, far and away larger than the one observed in the 1950s and 60s, which also got us out of the debt trap then, the post-war debt trap. Very similar situation. And it took us a while, a bit of yield curve control plus new technology. This time around, we might get yield curve control, but the new technology is really going to change everything.
According to Powell, all hope is not lost, and there is still a high chance that we can continue coasting along without any serious repercussions for Americans and other countries with strong currencies. However, investing is still very important and compulsory for everyone who wishes to maintain their wealth and increase it over time. However, asset classes like bonds will not rise quickly enough to make up for inflation. Popular stock indexes like the S&P will do just fine, helping you to maintain wealth without increasing it, but cryptocurrencies remain the top choice. According to Powell, only crypto and technology stocks will continue to outperform the rate of currency debasement. What are your thoughts on the video? Do you agree that AI and other fast-developing technological innovations present a solution to the world's massive debt problems? Please drop your thoughts, comments, and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.
Hey Savvy Finance enthusiasts, massive shout out for being the heartbeat of Savvy Finance. Your support has been the wind beneath our wings, and we can't express our gratitude enough. Now buckle up because we've got an exclusive deal just for you. Ever wanted a slice of the action? We're offering a golden opportunity to own part of our YouTube channel's potential future revenue. This isn't just an investment, it's an invitation to be a part of our story. Investing means you're not just an investor, you will be a participant in the future of Savvy Finance. No cheesy lines, just a genuine call to embark on this journey together. But wait, there's more. Your mission, should you choose to accept it, become a Savvy ambassador. Share our videos on every platform: Facebook, Twitter, LinkedIn. Your shares amplify our visibility, potentially translating to more views and more YouTube revenue. Here's the kicker. If our viewership increases, we would not be just growing financially. We would be making a tangible impact by spreading valuable financial education. Now the icing on the cake. Invest and you'll score exclusive access to our private Savvy Finance Discord. Here you can chat with Savvy Finance, swap ideas with fellow investors, and be at the forefront of exciting developments. Click on the link below to register your Gigastar account. You can also find the link to my offering page in the description below. Get your Gigastar account ready, review the offering details, and let's embark on this thrilling venture together. To the incredible Savvy community, thank you for being the backbone of our success. Your journey is my journey, and together, we're creating waves. Cheers.